Welcome back. You're watching Stock Watch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Thamsanqa Netha from Shiloh Capital and Gary Booysen from Rand Swiss. If you'd like to send questions, please email stockwatch@bdtv.co.za or SMS us on 41392. Gary, Tommy, good evening to you both. Tommy, if I may start with you, it wasn't the greatest start to the week for the JSE. Also, the Rand got a bit clobbered, but it did seem that it was a fairly universal pullback in markets today. So what happened?
It looks like the resources took a big beating. I think they were down 1.9%. The top 40 generally was down just under 0.5%. So I think there's a lot of jostling around commodities and commodity pricing, especially if you look at gas, oil, coal, metals, and across the board. So ironically, the mining that was happening now,
yes.
We're seeing quite a lot of movement around the commodity pricing and the ability to service that market, which obviously affects the JSE because it's quite heavily weighted towards mining's minerals, resources, and energy.
Gary, but what? So Tommy's relayed what was mainly behind the 0.5% pullback in the all-share index. But what spooked commodity markets in particular?
Well, I think it all comes down to the non-farm payroll number we saw on Friday. It was just absolutely incredible. So, 353,000 new jobs added. Labor market is hot, and it's not just the jobs added in January. It's the massive revision that we got in December. 333,000 jobs added in December. So that kind of saying the U.S. labor market is still very, very hot. The idea that whatever your inflation expectations were, you should modify them up a little bit because people are going to be demanding higher wages. If you thought that the Fed was going to cut in March, you were wrong. There's an 86% chance that they're going to stand pat according to Fed funds futures. Although they're still mid-year, you're still looking at about a 90% cut. But it's that dynamic for me playing out in the market today. So we had the financial, the FINI up, NICE is up about 0.7% for most of the day. I think it did just sag into the end of the session. And as you said, resources on the back foot. Industrials were kind of nowhere. They went, they were kind of flat for most of the day, and then also just they actually just poked their head positive, finished slightly green. But all of that is just that for me is just the dollar pricing. I mean, if you get commodity markets want a weaker dollar, and we have a much stronger dollar at the moment, which you can see in the rand dollar pair. I mean, we're well above 19 to the dollar again.
I know, it was horrible. It's a 2.6% decline in the rand today. No, sorry, I lie. No, I don't lie. 2.6%. That was how much we weakened today. Tommy, going back to Gary's points about the Fed funds rate now pricing in no rates. It's unlikely that you'll get a rate cut in March. Jay Powell said on the weekend there will be 3 rate cuts this year. So do you take that as gospel? And is that a nasty message for a market?
I think. So the old adage of saying, if I threaten to increase or I comfort you with the decrease of the interest rates, you will behave accordingly. So saying that there will be 3 cuts in the year may move markets to behave a particular way without them actually having to do the cutting. They want growth. They want to drive. It's an election year. There's lots of noise. And they have to show, Biden and co have to show that they're about the economy and they're making sure it continues to strengthen. Outside of that, I think 3 rate cuts during the year, we don't have a crystal ball, but given the way data is going now, is very unlikely. The exact opposite is more likely. With more jobs becoming available, less people going to work, wages are going to go up, inflation is going to go up. So it's going to be, I think, an inflation story for a long time. So 3 cuts is quite aggressive, but it's letting you know of what's possible or what they're trying to achieve by indicating to the market, continue to invest in the economy, drive for growth. We will do our bit. I don't know if that message and the data align.
Okay. And Tommy also mentioned the mining Indaba, Gary, and there's a question from a viewer who says, at the mining Indaba in Cape Town today, our President and Mineral Resources Minister are super upbeat about the prospects of mining in South Africa. Is this a sign that I should start investing in resources stocks now? Or is it, as the cynic would suggest in me, it's the rah-rah message that they have to give? And do you as an investor get sucked up in that message, or do you play it a bit more carefully?
I think you've got to be careful as well. So just going and buying mining stocks on our exchange, if you need to look at which mining stocks you're buying, number one, because there's so many multinational mining stocks that have nothing to do with South Africa that, because of legacy, still are listing on the JSE. So I think be careful of the mineral, as always. Be careful of the mineral that you're investing in. Be careful of the specific mines that you're getting exposure to. But I think that the cynic in me also says that you have to kind of, this is your opportunity in front of the international community to showcase our mining sector and try and hook international investment. At the moment, if you look at exploration, I mean, we really need exploration here. I mean, we're attracting less than 1% of the global funds available for mining exploration, and that's very sad. And the problem is that we have the skills locally as well, and it really comes down to the policy around it. So I mean, the one thing that I was encouraged to hear was just I suppose the overhaul of the mining rights system and kind of the deadline saying we will have this sorted in the year. Whether that's true or not, who knows? But it's definitely the right message to give to the markets. It's definitely what people want to hear. You want to hear policy certainty. You want to hear that if you come to South Africa and make a massive investment in the mining sector, you will reap the reward of that longer term.
Yeah, the cadastral system has been a disaster, and it has been a disaster for years, and practically over the entire tenure that Gwede Mantashe has been the Mineral and Energy Resources Minister. So really, Tommy, do you like any mining stocks on the JSE? Are there any particular minerals that you think might do well this year?
Yes, I do have some, but I'll leave that for my stock pick.
Ooh, okay.
Because my stock pick is a minerals pick. But I agree with Gary in the sense that mining policy certainty is great. I think they're right. The resources are here. We need to attract the capital. What they're not talking about is the logistics around that, Transnet and getting minerals to port and energy. So those two elements are more of a distraction, or they take away from an investor wanting to put in capital full time. The mineral is there, the labor is there. We've got skilled geologists, mining engineers, everything is there. But if I put in R1 billion, can I actually export the mineral that I'm mining? And can I mine it at a reasonable cost given the change of energy? So they are quite correct in promoting the one side, but the policies and the implementation of it on the other is quite lacking.
Yeah. But there did seem to be some acknowledgement that unless they fix Transnet, nothing's going to get any better. So let's hope they do. Then a question that came through late on Friday, which is quite an interesting conundrum, I think, for some investors. And I imagine this person is not alone. And she writes, I bought First Rand shares during the 2020 COVID crash at about 43 Rand a share. And I've seen just over 50% growth in share value since. Should I sell and put the money into a global ETF or hold on to the shares a little longer? Gary, starting with you. What would you do here?
Starting with me. It's a good question. So, yeah, I mean, well done on the trade. I think we were also very, very optimistic on I suppose, local banks that were very, very cheap. You had interest rates on the way up, and that generally does work out well for banking stocks. Is here the time to take profit on First Rand? I don't know. It really depends on your overall outlook. So, if you're kind of celebrating the First Rand win, but if you'd taken your money out back then and stuck it in an S&P 500 tracker at the COVID lows, you probably would have done a lot better. So, it comes down to trying to time the market as well. If you go and look, so I always look at the Signia US tracker. I kind of point to retail investors. If you want to see what the performance has been like on the Rand S&P 500, because it's obviously priced in Rand, and it's absolutely spectacular. To sell First Rand now, you are going to be buying this market right at record highs, just about it in Rand terms, definitely in record highs. You've got the currency blowing out. You've got the S&P 500 kind of making new highs as well. So, I mean, you're kind of going into what looks like a very, very expensive market if you're kind of more of a short-term trader. Be maybe a little bit cautious and look for a pullback. I also don't think that First Rand is in a bad position at the moment. I still think First Rand is cheap compared to international peers. So for me, I mean, I probably wouldn't be rushing to the exits on First Rand just yet, especially when we've been discussing our interest rate forecast and kind of seeing them pushed out a little bit. There might be a little bit more juice in First Rand that you can sell out of, and then you're really looking for a stronger currency to exit into the international markets. But as Julieta made the point before the break, it depends on your time horizon. If you're super long term, the way you take your currency out probably doesn't matter so much.
Yes, well, that's what I try and comfort myself with, you know. Tommy, your thoughts there? Because also, I mean, Gary's talking about the S&P 500, but that's not the only global market that you can enter,
Sure.
you know. Tommy, so firstly, would you sell out of FirstRand, or would you maybe, if you had any other capital lying around, would you just use that?
I would say to the viewer, firstly, take out your capital. You're 50% up. Leave that 50% to play, and take the capital offshore. That would be my trade in that regard. I think
Okay.
if you do have a bet on South African banks, I think it's a good one in general. I think they are high earners. They're good. They're resolute, well ranked, and every now and then there'll be a dip, credit cycles. But I think overall, as a banking group, especially when you look at an entire group like FirstRand, I think there's value there. Offshore, I think you're looking more for protection and medium-term capital growth. And I think if you are risk averse, that's a good play. If you are interested in holding over the long term and taking the dips of FirstRand over time, then I would say stay. But to answer specifically that question, I would say take out your capital, leave your profit, and move your capital offshore.
Okay. And where would you go? I mean, Gary has pointed out, you know, you've got US markets trading close to all-time highs. Are there other markets that tempt you, you know? World's a big place.
Southeast Asia does tempt me to some degree, but for someone who's a retail investor, I'd say stick to the S&P. It's been reliable over 100 years.
Okay. Gary, and you, I mean, would you look at it like a world index, an MSCI world index, if you felt it?
Again, it comes down to the underlying investor. This is where you almost like, oh, I wish I could just speak to this person directly,
the
because
individual, yes.
there's so much more that you can probably
Yes,
offer.
yes.
But if you're looking purely at price, I mean, we are still massively in favor of the US as the ultimate investment destination. I think we're very, very concerned around China at the moment. Yes, the stock prices look very, very cheap. Yes, we've had announcements that the government would be supporting the markets, but there was a Goldman Sachs conference last Wednesday, and they had a session on China, and they pinged the audience, and I think 40% of the audience said China was uninvestable. I'm not trying to shoot down Tommy's pick, because there are very, very interesting areas of Southeast Asia, but that whole region, even Australia, is so reliant on China as their big neighbor. And if you can't see China coming right in the short term, remember, longer term, they've got demographic issues, the average working age, the working population at least is aging. You've got regulatory uncertainty run by a leader that is getting older and older with essentially absolute power. It's a very, very difficult place to invest in. Europe, I mean, Europe will be affected by what's going on in the Middle East at the moment. Also very, very difficult. Also has demographic issues. There are some really, really bright spots in Europe. I mean, Novo Nordisk, ASML. There's all sorts of very, very interesting companies in Europe. But to go and buy, as you say, a tracker, going and looking at something like the Euro stocks, yes, it's cheap, but for me, it's cheap for a reason. There's some very, very interesting companies in Europe, but you can't just go buy a European index, in my opinion. I kind of have left with this. I kind of like the idea of, I mean, we haven't made any sort of recommendation around it yet, but we like the idea of Latin America at the moment. I think that's something that we're exploring, but we don't have any recommendations. Still doing our groundwork.
There was a question also that came through on late Friday evening, asking whether you could still buy life healthcare shares on Monday to receive dividends. So it's probably post the fact. I imagine, I don't know, Gary, do you know the answer? Is it no?
I haven't pulled it up yet, unfortunately. I'll get it for you by the end of the show.
Tommy, do you know offhand?
No, I don't.
Okay. So then on to a different question. A viewer asks for the panel's view on City Lodge, Coronation, Dis-Chem and Discovery. Tommy, sticking with you. City Lodge was one of my Crystal Challenge stock picks this year, which might be crazy, but I'm hoping it's going to have a massive rebound. What do you think of it?
So I think their targeting of business travel is very good. However, they've entered a very competitive space, so they're competing against hotels and Airbnb in terms of business travel as well. So I think that's where the rub will be. But in an economy where people are cost cutting and managing, and people have to travel for business, I think they're a viable option. So I think your call has a high probability, higher than it was last year, definitely. Dis-Chem, I think they're a great business. Their add-ons, Baby City, I think was a great business add-on. And I think they're gonna, in their group, if you compare them to like Clicks or other alternatives, I think they're great performers. I don't know if the business as it is a great investment, but in its grouping in comparison to its peers, it does very well. I forgot the other two, sorry.
No worries. The other two were Discovery and Coronation.
Discovery, I think, is a great stock to buy. I think it'll continue to deliver returns, especially with the bank and as well as the data. So they've got a big data source on a lot of us in South Africa. And I think that data is going to become more valuable and meaningful to them as they innovate going forward. So I think their future is going to be around how they manage the healthcare and financial data of all the clients they have. Poppy Act will intervene there, but I think they have it. They can use it for analytics and can, I think, turn it into something valuable for users.
Yeah.
And I think that's a good stock to buy. I would say by Discovery. Coronation, I think it's difficult. I think the ship is too big. I don't know if they are able to drive sizable returns going forward. The upside is they pay dividends, which is great. So if you are into buying for dividends, they pay great dividends. But I think the long-term competition is going to be difficult, especially if you're looking at someone like 91 that is multi-jurisdiction. They have the ability to be more nimble because they've got assets offshore. Coronation has to deal with the central bank and other issues, and then the cost of management and the fees and the view of fees going forward, especially in South Africa, the comparison of fees from offshore or ETFs and South African asset managers is going to be tough. So I think they're in for, in my view, they're in for some choppy waters.
Gary, I mean, Coronation, Tommy rightly said, well, it was a good dividend payer, but of course last year it had this tax issue with SARS, so it withheld the dividends. Do you expect those to come back this year?
It's a good. I mean, Coronation. If you look at it like asset management, I mean, it is a fantastic business model, and I agree with Tommy that it is a big ship that you do. It's difficult to turn a ship that size, but there's a massive benefit to the economy of scale that you're receiving with something like Coronation as well. So, longer term, you would hope that the tax issue is a short-term thing, and if you're investing, for 5 to 10 years, you would very much expect dividends to return and the stock to be on a good trajectory going forward. There's just a lot of advantage to scale. At the same time, I think the whole market is becoming so much more competitive. There's fintech disruption. There's all sorts of new players and new ways of investing. I think so many more people are taking their own investments on. You have AI and ChatGPT, and you have amazing resources at your disposal as someone who is interested in making investment, that the idea of using the more traditional asset managers to go and buy a balanced fund or go and buy an equity fund where you've got tools like ETFs that you can go overseas with. You can really construct so much of this yourself these days that I think longer term, is the business model under threat? Maybe to an extent, but I still think, I mean, Coronation, I wouldn't be averse to having Coronation in a portfolio if you're looking for a fairly defensive asset manager.
And then Discovery, City Lodge, any thoughts there?
Discovery, I like Discovery as well. I think there's still execution risk around the bank. I think the bank is, it's a huge opportunity, but it's a huge risk at the same time. I think what they're doing, I mean, I think their operational excellence and execution is very, very solid. But there are risks with them moving into the banking space. NHI also like a big risk to the business as well. We don't currently hold it in portfolios, but it's something that we've been looking at. Haven't quite been convinced yet. City Lodge, for Crystal Challenge stock, probably a decent bet. I mean, over the last 5 years, down 81%, and you always win those kinds of challenges.
Yeah, I figured it would be a binary outcome,
Yeah, it's either going to to be terrible or it's going to be great. So,
look, City Lodge, given that I picked it,
No, we don't. Must I talk it up?
No, I'm saying it's probably likely to be terrible, but yeah.
No. It's going to get a lot of coverage on the channel about specifically when it comes to buy signals. But no, I think City Lodge, I think Thamsanqa covered it as well. I mean, interesting business, but also kind of ripe for disruption as well. So it's, you've got all sorts of like the likes of Airbnb, you've got the likes of Booking.com as well, eating into their margins. These big travel platforms, really are putting hotels under pressure. The kind of traditional model of City Lodge, which was, you get the same experience no matter what, can now be replicated through something like TripAdvisor, where you go online, you see what stars they are, you see what the reviews look like, and you can kind of tell, oh, well, that's going to be a nice place to stay or not. So that idea of, you need the kind of almost McDonald's model, like what you get when you go to City Lodge, I think that has to an extent been disrupted as well.
Yes.
But as Tommy says, if business travel picks up, if the economy starts to pick up, vacancies will reverse, and it should be okay.
Yeah. And very quickly, before I get to your stock picks, panel's view on Japan and India, seeing we're going global tonight. Tommy, very quick view, I don't know, on either or both.
No, on both. I think it's going to be very hard to invest and to extract value on either. Japan, underwater as an economy, been deflating since I was in primary school, and India, I think it's just execution. How can you trade, execute, and is it a profitable investment? Rather look for companies with that exposure in other jurisdictions with high liquidity and ease of execution.
Gary, you also seem dubious, very quickly.
No, well, very quickly. So we've got views on both. So I think the demographic challenge around Japan is significant, and I think if you're looking at dollar-based returns on Japanese companies or on a Japanese index like the Nikkei, I think you're going to struggle. That said, I think their price index is going to do very, very well because they've got very expansionary monetary policy. They cannot afford to increase interest rates because of the massive debt burden in the country. So I think you're going to see yen weakness. So you can actually see, because so many of their companies, like the likes of Toyota and Nintendo, are essentially multinational, you're going to see the Japanese price index doing really, really well. So the way that we play it is through auto calls. So we bet on the price index without needing to take a US dollar bet. So we take a bet on the price index going up, but then we get paid out in US dollars when we're right. So that has worked out absolutely spectacularly. The market hit kind of 34-year highs in yen. So you've just got to, like for us, there's a way of playing Japan, but I think just going and buying Japanese stocks is not the right way. I agree with Tommy, India, a difficult place to execute into, but we do like it as a destination from an economic point of view. I think there's very big growth, and if you can unlock it in India, very interesting market to explore.
Yeah. Okay, a minute and a half between you two for your stock picks. So Tommy, you said it was a mineral company. Which is it?
Pan-African Resources and gold. They got tailings, underground, and above ground mining and excavation. So I think they've got a good set of assets, and going forward, I think they'll do well. I foresee also, in our view, gold is going to be a significant player in the economy going forward, in the global economy going forward.
Yeah, and this is like a really steady little operation with some very interesting assets. Okay, so Pan-African Resources for you. Gary, how about you?
I'm going defensive and defense. So I'm going to go with Lockheed Martin internationally. So it's essentially a bet on the US military industrial complex. All these defense companies, they have seen margins compress. The one benefit that you have is you have this big buyer. I mean, 73% of their revenue comes from the US government. Their buyer's not going to run out of their money. But the problem is you have one huge client as well. And when that client decides to put pressure on your pricing, that also makes a difference to you. But really, I think if you're looking at a company that, it's a long track record, it's very, very safe earnings that you're buying into. They've had a couple of operational problems recently. F-35 deliveries, they kind of forecast between 100 and 120 last year. They delivered 98. But that's it. There's an amazing pipeline that should build up. You get an increase in geopolitical tensions like we have now, and the stock will essentially be counter-cyclical as well. So you might see markets coming off, but as a defensive player, the stock can still do very, very well.
Okay. Gents, we have to leave it there, unfortunately. Thank you so much, both of you, for your insight this evening. Thamsanqa Netha is from Shiloh Capital, Gary Booysen is from Rand Swiss, and we'll be back with the close just after this.